January 6th, 2026, a date that will be remembered as the day the fortress fell. For 2 decades, Bank of America told the world to avoid silver, called it a relic, a speculation, a mistake. But this morning, something broke. The institution that spent billions suppressing precious metals just issued a research note that changes everything. $309 per ounce. Not a typo, not a theory, an official target. But here's what they're not telling you. The paper price shows $80. Yet try to buy physical silver today, and dealers are quoting $95, $100, some even higher. The market is split in two. And when the world's most powerful banks start positioning for a number that is nearly 4 times higher, while China floods the system with $48 trillion in fresh liquidity, and 4.4 billion ounces of short positions hang like a sword over the financial system. The question isn't if this breaks. The question is, how many days do we have left before... Welcome to Currency Analyzer. If you've made it this far, you're not here by accident. You're here because you understand that what's happening in the markets right now isn't normal. Now, I'd like to ask you something. You know how your grandfather, or perhaps your father, used to tell you to always read the fine print, to pay attention when the big players start changing their story? Well, this is one of those moments. And if this analysis makes sense to you, if you want to stay informed as this situation unfolds, I'd be honored if you'd subscribe to this channel. Just click that button below, the way you'd bookmark an important document. No rush, no pressure. But don't forget, because what we're about to walk through in the next few minutes, you won't hear anywhere else. Oh, and one more thing. Drop a comment below and tell me, where are you watching this from? London, Singapore, New York, Mumbai? I'm genuinely curious, because what's happening with silver right now, it's global, and I want to know how many of us are paying attention. All right then, let's begin. On the morning of January 6th, 2026, something unprecedented happened in the world of global finance. Bank of America, one of the largest and most influential financial institutions on the planet, released a research report that sent shockwaves through every trading floor from New York to Hong Kong. For those who understand what this institution represents, this wasn't just another market update. This was a surrender. For over 20 years, Bank of America had maintained one of the most bearish stances on precious metals in the entire banking sector. They told their clients year after year that gold was overvalued. They insisted that silver was nothing more than a speculative asset, a relic of the past with no place in modern portfolios. Their analysts appeared on financial networks, wrote detailed reports, and consistently recommended that investors avoid these metals entirely. But something changed. The report that landed on trading desks this morning contained numbers that seemed impossible. Bank of America's new official price target for silver, $309 per ounce. Not $50, no, not $75, not even $100, $309. To understand the magnitude of this reversal, one must look at what they were saying just months ago. In their previous guidance, they suggested silver was fairly valued around $25 to $30 per ounce. They warned clients that anything above $35 would be speculative territory. Yet now, the same institution was projecting a price more than 10 times higher than their previous recommendations. But the silver target wasn't the only shock in the report. Bank of America also revised their gold forecast, setting an average price target of $4,138 per ounce. This represented more than double the previous all-time highs. More importantly, it represented something else entirely. A projection of $4,138 for gold doesn't simply suggest a bull market. It suggests a fundamental breakdown in the global monetary system itself. Gold only reaches such levels when confidence in paper currencies begins to collapse, when central banks lose control, when the mathematics of debt become impossible to ignore. But perhaps the most revealing detail in the entire report was hidden in a single paragraph about portfolio allocation. For decades, major banks recommended that clients hold between 0 to 5% of their portfolios in precious metals. This was the standard advice, the conventional wisdom. Gold and silver were treated as minor hedges, small insurance policies against catastrophic events that would probably never happen. Bank of America's new recommendation, 20 to 30% allocation to precious metals. Read that again. They were now telling clients to put nearly 1/3 of their entire wealth into gold and silver. This wasn't a minor adjustment to a portfolio strategy. This was a fundamental repositioning, a complete reversal of decades of institutional thinking. When a bank tells you to move from 5% to 30%, they aren't tweaking their model. They are acknowledging that the other 70%, the stocks, the bonds, the traditional assets, are facing existential risk. But why now? What changed? Bank of America didn't make this decision because they suddenly developed a fondness for precious metals. They made this decision because they saw something in the data, something in the global financial system, that forced their hand. The analysts at major institutions have access to information that most investors never see. They track physical metal flows between countries. They monitor central bank purchases in real time. They have direct relationships with mining companies and refineries. They know, to the ounce, how much metal is actually available versus how much is being promised on paper. And what they saw in that data terrified them. The report mentioned supply constraints. It acknowledged rising production costs. It noted increasing industrial demand. But more than anything, it revealed that the institution could no longer maintain the narrative they had been selling for 2 decades. The evidence had become overwhelming. The physical market was moving in a direction that no amount of paper trading could suppress anymore. Bank of America wasn't issuing guidance. They were issuing a warning. And when the suppressors become the warned, when the institutions that spent billions keeping prices down suddenly flip to the other side, that's when experienced investors understand the game has fundamentally changed. Because Bank of America didn't just raise their price targets. They validated what a small group of analysts had been saying for years, while being dismissed as conspiracy theorists. The emperor had no clothes, and now even the emperor's bankers were finally admitting it. But this was only the beginning. The real question wasn't why Bank of America changed their position. The question was, what did they see coming that made them move so dramatically and so publicly? While Western financial analysts were still processing Bank of America's shocking reversal, something far larger was already in motion. 7,000 miles east of Wall Street, in the marble halls of Beijing's financial district, a decision had been made that would reshape the entire global commodity market. The People's Bank of China had just initiated the largest monetary expansion in human history. Not the largest in Chinese history, the largest in human history. The numbers were staggering. China's M2 money supply had expanded by 48 trillion yuan in a single coordinated move. To put this in perspective, the entire money supply of the United States, accumulated over centuries of economic activity, stands at roughly $21 trillion. China had just printed more than double that amount in weeks. When the Federal Reserve printed $5 trillion during the pandemic crisis, the world witnessed inflation surge across every sector. Housing prices doubled in major cities. The cost of groceries increased by 50%. Basic goods became unaffordable for millions. That was $5 trillion. This was $48 trillion. But here was the critical difference that Bank of America's analysts had noticed. When America prints money, it flows into financial assets. The newly created dollars get absorbed by stock markets, by corporate bonds, by real estate speculation. They inflate the prices of things that already existed. China was doing something entirely different. The 48 trillion yuan wasn't being used to prop up failing banks. It wasn't being injected into their stock market. It wasn't bailout money for over-leveraged property developers. Instead, the Chinese government was executing a strategy that revealed a level of sophistication Western economists were only beginning to understand. They were converting paper into permanence. Every newly printed yuan was being systematically deployed into global commodity markets. Not derivatives, not futures contracts, not paper promises, physical commodities. Oil tankers were being purchased at unprecedented rates. Copper warehouses in Chile were being emptied. Agricultural products from Brazil were being bought in quantities that exceeded normal trading patterns by factors of 10. But the most aggressive accumulation, the one that caught the attention of every precious metals analyst on the planet, was happening in gold and silver. Chinese entities, both state-owned and private, were vacuuming up every available ounce of precious metals they could find. The London vaults, traditionally the deepest pools of physical gold and silver in the Western world, were reporting outflows at rates never seen before. Swiss refineries, the arteries through which most of the world's gold flows, were working at maximum capacity. And every ounce they produced was heading in one direction, east. This wasn't investment behavior. This wasn't even aggressive accumulation. This was strategic repositioning on a scale that suggested China knew something or expected something that they weren't publicly discussing. The mathematics of their strategy was brutally simple. They were offering the world a trade. We will give you this paper currency we just created, and you will give us commodities that took millions of years to form and billions of dollars to extract. And incredibly, the West was accepting the deal. Western mining companies were selling their silver production to Chinese buyers. Western refineries were melting down scrap metal and shipping it east. Western commodity traders were writing contracts that promised future delivery, not realizing they were participating in a wealth transfer of historic proportions. Because China understood something fundamental about commodity markets. There's always a price, but there isn't always supply. You cannot print oil. You cannot create copper with monetary policy. You cannot quantitative ease your way to more silver. Physical commodities have hard limits, and whoever controls those commodities when the paper system breaks controls the next monetary system. The 48 trillion yuan injection wasn't inflation, it was insurance. China was backing their currency with real things, with resources, with metals, while the dollar remained backed by nothing but debt and military power. And this created a phenomenon that commodity traders were now calling the unlimited bid. In normal markets, when prices rise, buyers eventually step back. They wait for corrections. They look for better entry points. But China wasn't behaving like a normal buyer. Every time silver prices dipped, Chinese buyers absorbed the entire dip. Every time gold pulled back, Eastern accumulation intensified. They weren't trading for profit, measured in dollars. They were accumulating for survival, measured in ounces. This created a floor under precious metals prices, a floor that rose higher every single week. And this floor, this relentless Eastern demand backed by virtually unlimited paper currency, this was what Bank of America had finally acknowledged. They realized that no amount of paper selling in New York could overcome a 48 trillion yuan buying program in Beijing. The immovable object had met the unstoppable force, and the immovable object was breaking. But there was still another layer to this crisis, because while China was buying everything they could find, Western banks were trapped on the opposite side of a trade that was about to destroy them, deep in the trading floors of Manhattan, London, and Zurich. A quiet panic was spreading among the risk management departments of the world's largest banks. Numbers that had seemed manageable just months ago were now revealing themselves to be something far more dangerous. A trap that had been built slowly, over decades, was finally tightening, and there was no way out. The weapon that was about to detonate wasn't visible on any balance sheet. It didn't appear in quarterly earnings reports. Most investors had no idea it even existed. But the traders knew, the quants knew. And now, Bank of America knew. The Western banking system was collectively short 4.4 billion ounces of silver. To anyone unfamiliar with commodity markets, this number might seem abstract, just another figure in an endless stream of financial data. But to those who understood the physical reality behind that number, it represented something catastrophic. Let's establish the scale. Every year, every mining operation on planet Earth, combined, extracts approximately 800 million ounces of silver from the ground. That's the total global production. That's everything from Mexico, Peru, China, Poland, Australia. Every mine running at full capacity, 800 million ounces. The banks were short 4.4 billion. Do the mathematics. 4.4 billion divided by 800 million equals 5.5. The banking system had sold, on paper, 5.5 years worth of global silver production. They had written contracts promising to deliver metal that didn't exist, betting that they could always buy it back cheaper before anyone demanded physical delivery. This wasn't hedging. This wasn't risk management. This was naked shorting on a scale that defied comprehension. In equity markets, when a hedge fund shorts 20% of a company's available shares, regulators call it dangerous. When they short 50%, it makes headlines. When GameStop's short interest reached 100% of available shares, it triggered one of the largest short squeezes in market history. But here, in silver, the banks weren't short 100%. They were short 550%. And unlike stocks, where companies can issue more shares, you cannot issue more silver. Geology doesn't care about margin calls. The trap had been set years ago. When silver was trading at $25, banks had sold massive quantities of paper contracts, confident that industrial users would always settle in cash rather than demand physical delivery. For years, the strategy worked perfectly. When contracts came due, traders would simply roll them forward or accept cash settlement. The banks would profit from the premiums, and the physical metal would never need to move. But something fundamental had shifted in the market structure. The buyers were changing. A decade ago, most silver futures were traded by speculators, by hedge funds looking for short-term profits, by traders who had zero interest in actually holding physical metal. They were financial players in a financial game. Cash settlement was perfectly acceptable. But today, the counterparties demanding delivery were completely different. China wasn't speculating. The solar industry wasn't trading for profit. Defense contractors weren't playing price games. These entities needed the actual metal. A solar panel manufacturer cannot build their product with a cash settlement. A missile guidance system cannot be constructed with a wire transfer. China cannot back their currency with a derivative contract. They demanded physical bars, stamped, assayed, delivered. And when they stood for delivery against the 4.4 billion ounces of paper promises, the vaults held less than 300 million ounces of actual metal. The banking system had written checks that the physical market couldn't cash. Every dollar that silver rose was costing these institutions $4.4 billion in mark-to-market losses. At $80, They were already underwater by hundreds of billions. At Bank of America's target of $309, the losses wouldn't just be catastrophic, they would be terminal. But the money wasn't even the primary concern anymore. The real crisis was the delivery obligation. In the past, banks could always negotiate their way out. They could offer cash settlements at premiums. They could convince counterparties to extend contracts. They could manipulate the paper price downward to shake out weak hands. But those tactics only work when the counterparty is willing to negotiate. China wasn't negotiating. The solar industry wasn't negotiating. They wanted metal, not promises. And this created the scenario that every risk manager fears most, a forced liquidation in an illiquid market. When these banks eventually receive the margin calls, when they're forced to cover their short positions, they will have to enter the physical market as buyers. The same institutions that spent 2 decades suppressing the price will suddenly need to acquire billions of ounces to close their positions. But from whom will they buy? China is accumulating, not selling. The mining industry produces only 800 million ounces annually, already spoken for by industrial demand. Private stackers who understand what's happening aren't selling at any price. The banks will be bidding into a vacuum. They'll offer 85, no sellers. They'll offer 95, no sellers. They'll offer 120, still no sellers. This is how vertical price movements occur. This is how markets gap up 20% in a single trading session. This is how $309 stops being a target and becomes a footnote on the way to somewhere much higher. Bank of America saw this trap. They calculated the mathematics. They realized their institution was standing in the path of an avalanche with nowhere to run. And so they did the only logical thing remaining. They surrendered. They switched sides. They published the target, warned their clients, and began repositioning. But even as they moved, even as they tried to exit their short positions carefully, another crisis was emerging that made the short squeeze look manageable by comparison, because the metal they needed to buy was vanishing from the earth itself. There's a fundamental misunderstanding that exists in the minds of most investors. They believe that when commodity prices rise, supply automatically increases to meet demand. It's basic economics, taught in every university, repeated in every textbook. Higher prices incentivize production, and equilibrium is restored. But silver doesn't follow these rules. And Bank of America's analysts had finally understood why. In their report, buried beneath the dramatic price targets and portfolio recommendations, was a single line that revealed the true scope of the crisis. Global silver mine production is expected to decline by 2% in 2026. 2%. It sounds almost insignificant. A rounding error in a world of trillion-dollar money printing and billion-ounce short positions. But in the context of a market already experiencing explosive demand growth, a 2% supply contraction isn't a minor inconvenience. It's a famine. Because unlike financial assets that can be created with keystrokes, silver is bound by the laws of geology, and geology is merciless. When an investor wants to buy more Tesla stock, the company can issue new shares. When a government needs more currency, central banks can print it. But when the world needs more silver, there's no dial to turn, no lever to pull. The metal either exists in the ground, or it doesn't. And increasingly, it doesn't. For the past century, humanity had been mining the easy silver, the high-grade deposits that sat close to the surface, the veins that yielded 15 ounces per ton of ore, the mines that could operate profitably at $30 per ounce. Those deposits are exhausted. What remains is deeper, lower grade, harder to access. In 2005, a typical silver mine might extract 15 ounces from every ton of rock processed. Today, that same mine is lucky to get 4 ounces. The mathematics of this degradation are brutal. To produce the same amount of silver, miners now have to move nearly 4 times as much rock, 4 times the diesel fuel, 4 times the electricity, 4 times the labor, 4 times the equipment wear, and all of those costs have been rising faster than the price of silver itself. Energy prices have surged, labor costs have increased, equipment has become more expensive. The all-in sustaining cost, the true expense of getting an ounce of silver out of the ground and into a refined bar, has skyrocketed. At $70 per ounce, many mines were operating at break-even or slight losses. Some were shutting down entirely. But here's where the situation becomes truly dire. Even if silver reaches $300 tomorrow, new supply won't appear, because mines don't work like factories. A factory can add a night shift and double production within weeks. A mine requires a decade, from the moment a company identifies a potential silver deposit to the moment the first ounce is extracted. 10 years typically pass. Geological surveys must be conducted, environmental permits must be obtained, infrastructure must be built, roads, power lines, processing facilities. Capital must be raised, equipment must be ordered and installed. A workforce must be trained, 10 years, minimum. So if the world suddenly needs dramatically more silver than current production can provide, the supply response won't arrive until 2036. For the next decade, Global markets are locked into the production capacity that exists today, and that capacity is shrinking. But there's another layer to this crisis that makes it even more intractable. Most silver isn't actually mined for silver. Nearly 70% of all silver production comes as a byproduct of other mining operations. When companies mine for lead, they get silver. When they mine for zinc, they get silver. When they extract copper, they get silver. This means silver supply is held hostage by demand for completely different metals. If the global economy slows, if construction declines, if demand for base metals drops, miners will reduce their lead and zinc operations, and silver supply will collapse as collateral damage. The world could simultaneously experience surging silver demand from solar panels and Chinese accumulation, while supply plummets because copper mines are closing. It's a perfect storm of geological scarcity. Bank of America's analysts understood this. They ran the projections. They calculated the supply deficit. They realized that at current demand growth rates, combined with declining production, the market would face a shortage measured not in thousands of ounces, but in hundreds of millions. There simply isn't enough silver being extracted from the earth to satisfy industrial demand, investment demand, Chinese accumulation, and the covering of 4.4 billion ounces of short positions. The mathematics don't work. The geology doesn't exist. And unlike previous commodity squeezes that eventually resolve through increased production or demand destruction, this one cannot be solved. Because you cannot negotiate with a depleted ore body. You cannot print silver into existence. You cannot speed up the formation of metal deposits that took millions of years to create. The supply is what it is, and it's not enough. This was the final piece of the puzzle that forced Bank of America's capitulation. They weren't just looking at market dynamics or Chinese buying. They were looking at the periodic table itself and realizing that element 47 was becoming scarce, not just expensive, scarce. And when strategic materials become genuinely scarce during a period of explosive monetary expansion, price discovery enters a realm that traditional financial models cannot calculate. Because the market isn't asking what's a fair price. The market is asking, is there any left? And increasingly, the answer is no.